It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. And welcome. Hey, did you notice something, Professor Plum?
What would that be?
That 2020 is over. Hey!
Let's just hope 2021 is better. But, you never really know, do we?
We don't know. We're like 5 days into it already. And, it seems a lot like 2020, quite frankly.
But at this point of the year, it seems like 2019, 2018.
I look back, I forget, I don't make New Year resolutions, but some of the stuff that I thought I was going to accomplish in 2020, none of it. Who would have thunk? I got to think 2021 is going to be better. It is just no way.
It'd be hard to be worse.
Really would be. It really would. And if it's going to be worse, I don't want to be a part of it. I'm going to go live in the North Pole somewhere.
Well, that's not true. You had a very good 2020. It was a different 20. You had a wonderful wedding for your daughter. It was different than what was planned, but It was still
we had a partial wedding. Yeah, we're going to have another one in July, part 2. Yeah. where everybody's invited. So you're right.
We'll see if they are able to make it.
No, that is true. My team won the Super Bowl last year. My Kansas City Chiefs, whom I've been cheering on since 1969, when the last time they won the Super Bowl. And 50 years. So, yeah, there were some good things that happened. Some very good things happened.
Of course, that was before the initial lockdown. We'll see what happens with this.
Yeah, who knows? But anyway, we're here and we welcome you. Not that you need us to welcome you to a year, but we are here. I am Johnny Dean. This is called Managing Your Financial Future. I'm your moderator. I am not a financial advisor. And oddly enough, I've never played one on TV either. What was the original one? What was that? I'm not a doctor. No. I'm not a doctor,
but I play one on TV.
Yes, I was looking into that. I don't know if it came up on this or somewhere else, but I was wondering where that came from. I had thought that phrase came from the guy that played Marcus
Welby, MD.
But that it turned out that was not the case. He did do commercials, but back then they didn't say he's not a doctor because they were allowed to do things like that, making people think. So I looked it up. And I'm trying to remember. It was for Vicks Formula 44 cough syrup. There was a commercial, and I forget the guy's name. He was on a soap opera. He played a doctor.
Dr. Rick Weber.
Who was it?
Well, the character was Rick Weber from General Hospital.
Okay. Well, there's Dr. Rick Weber. Well, whoever this guy is.
Chris Robinson.
The well-known actor who... So apparently he was hawking Vicks Formula 44, and I don't know if they made him or whatever. They probably did come on and say, I'm not a doctor, but I play one on TV. Then he proceeded in this commercial that I had watched to act like a doctor giving advice. And I get it. But anyway, that was the...
So you're not an advisor, but you don't even play one on the radio.
I don't play one on the radio. I don't play a doctor on the radio. I did play a doctor in a high school or junior high school play once, and that was kind of fun. But other than that, no, I have no connection to it. So, no, I am the moderator. I'm not a financial advisor. But I am here talking with you, Professor Plum. You are a financial advisor. You're a certified financial planner, professional, CFP. And you've been doing this for a long time, 30 years, 30-plus years, whatever it is. And we do talk financial strategies with our folks here. We get into other stuff as well. But oftentimes, taxes play a big role in financial planning, tax management. Is that would you agree?
They definitely influence our decision on a lot of things. Sometimes because we are actually making sound decisions, sometimes because we're being ruled by emotion, and that isn't always a good thing.
Emotion can really take the more emotion you have, the less ration I think you have, rational thinking you have. And now, would you say, Professor Plum, that one of the ways to manage your taxes is to look at how different things such as IRAs, retirement accounts at work, things like that, how those things are taxed? Is that one way to look at tax management?
Well, to manage your taxes, you actually have to understand what is and what may not be taxable going forward. There's a difference between the investment taxability and the account taxability. As we know, IRAs are tax deferred. They're not tax free, they're tax deferred. We get away without paying taxes today, but we'll pay the taxes maybe in the future, depending upon what our tax bracket is in the future. So the idea is to manage where we are today, look into the future as best as possible to try to determine what our taxes might look like in the future, and invest accordingly and see whether or not we can make things more efficient for ourselves as we go along.
Yeah, and I guess it doesn't always work out that way, but you at least make the attempt to do so. Now, different types of accounts have different tax treatment. I think it's fair to say that. Let's run down a couple of those, Professor Plum. IRAs. Now, we talked to an episode or 2 or 4 ago about IRAs and the difference between, say, a Roth IRA and a traditional IRA. And a big part of that has to do with the tax.
Right.
You had said
tax me now or tax me later.
Right. One is not the polar opposite of the other, but it is in many ways an opposite of a Roth is kind of the inside out version, I think you said, of the traditional IRA. Why don't you go through those two tax treatments again for the folks who may have missed it?
Well, IRAs, the traditional IRA, the long-standing one we've had for a long time, if you do it right, you get the tax deduction today, and then you'll pay taxes when the money comes out in the future. And in the meantime, you don't pay any taxes while it's sitting there seasoning, so to speak. With a Roth IRA, there is no tax benefit today. The tax benefit is in the future. And in that respect, it's the exact opposite of the traditional IRA. The middle part, the seasoning part, is the same. You don't pay taxes on the growth or the earnings as it accumulates inside the account. And as long as you do it correctly with a Roth IRA, you get the tax benefit after 59 and a half, 5 years and all that, and it's tax-free at that point. So which is more beneficial to you? The tax break today and then paying taxes later on when you're retired, or not getting a tax break today, but having tax-free income in the future? So that's the way we look at those two types of accounts. When we talk about IRAs, we're also going to talk about, retirement plans, pension plans, 401ks, things of that nature. They're all lumped into the category of IRA because they are tax favored in the contribution, and then taxable when you receive the money later in life.
Yeah. So you use the phrase "pay me now, pay me late, pay me later." What we mean is you can take the money now, I guess, and pay taxes on it now, and potentially not pay taxes on it later. We get it out of the way now, or you're saying that you
don't pay taxes now, but pay later. So stealing from another commercial,
and not Pennzoil. Fram. I think it was Fram oil. Was it? You can pay me now, pay me later.
Right.
I think it was Fram oil filters. This goes way back. This is like late 60s, early 70s. You can pay me now or pay me later. But that's kind of that's kind of what this is, paying taxes now. So I guess, we've had questions from people who ask us, well, which is better, Roth, traditional? I know we talked about that on the last time we talked about IRAs and all that stuff. And your answer was it depends, as is the case in so often the case. It depends. What are your needs now? What are your future needs? And everybody's needs are different. So there's kind of what for a Roth and a traditional IRA, there is what would you call this? Maybe a single tax advantage, or are there any double tax advantages in those?
I obviously single, because you're either paying taxes today at federal and state rates if you live in a state with an income tax, and not paying it later. That's the Roth IRA, or you're not paying it today and you are paying it later. So the single double tax free depends on whether you're in a state income tax or not. Now,
are there any that allow for, let's say, a tax deduction now, and then later on, and you know where I'm going with this. I'm going with the double taxes.
And there's no unlimited amount of contribution to do this, but there are accounts that you can use in this flavor where you can get a tax deduction today, and potentially when you retire later on in life, take the money out and not pay any taxes. So you get both the tax deduction up front and potential tax-free income in the later. Now, it's somewhat misleading, but we can get into that as we go, because I think you're going for the health savings account.
It's exactly where I'm going. Yeah,
we all need health insurance. And for those that are not able to get it through their employer, with the employer picking up quite a bit of the bill, health insurance is dadgummed expensive.
And getting expensiver and expensiver, to make up a word, every single year. Really?
And so one of the ways that they've tried to help make it a little less expensive is to create what are known as high deductible plans, where you're on the hook for the first X amount of thousands of dollars a year, $8,000, whatever the number is. And then the insurance picks up the rest once you get past the deductible. The idea is that the insurance company won't pay as much, so they can keep your premiums down, that you're more careful of your premiums or more careful of your expenses, so you pay less. But in addition to that, they let you put money into a side account, a health savings account, to help pay for that initial deductible in the event you actually need to use it. I mean, if I have a traditional health insurance plan through my employer, I may have a $25, $30 copay, but then after that, everything's tax-free. The premiums that I pay for my insurance through my payroll deductions, tax-free. So a lot of it is done with pre-tax money. If I'm doing it on my own, or even if I'm doing it through an employer where they're paying for it, I want to be able to pay something. Now, the problem is a lot of times, especially people in their younger ages, middle ages, they don't need the doctor very much, but they need insurance just in case. And so they spend high dollar premiums, and if they don't ever go to the doctor, or they go to the doctor for a checkup once a year, they didn't spend very much on healthcare, and they've paid a lot in premiums, and the insurance company gets to keep all the premiums that they didn't spend on healthcare. With a health savings account, hopefully the premium is less because the insurance company is not on the hook for as much, and you are also saving into an account that you can use to pay the out-of-pocket expenses for that first deductible. But if you don't go to the doctor or don't need the doctor, you get to keep it. Unlike a health flexible spending account, where it's a use it or lose it issue, a health savings account is not a use it or lose it. If I'm putting $8,000 a year into my health savings account and I don't need it for healthcare, it's still my money. And I can roll it over to next year. I can add to it, and I can let it grow.
Well, HSA, savings account. That's really what it is. It's a savings account for your health benefits, potentially.
Right, to pay for that out-of-pocket expense that you would otherwise be on the hook for.
Right. Now, the FSA that you made mention of a moment ago is a spending account. It's flexible, but it's a flexible spending account, meaning that the money's got to be spent. Health savings account is a little bit different.
And I'm still taking money out of my paycheck in either case, taking money out of my pocket and putting it into the account. But with the flexible spending account, I need to actually spend it. Like you said, it's a spending account. And with the health savings account, it's there if I need to spend it. But if I don't need to spend it, I get to keep it.
Now, why do we call this? Why is this known as a triple tax-free saving option? Just take people through that. It's the only one that I think you've said it's the only one that you know of where there's a triple tax-free benefit.
Well, we go back to where are we getting our tax benefits? We get money. We get to save money by putting money. If I'm putting $5,000 into my HSA, I get to save the taxes, federal and state, on the $5,000 I put into that account. That's a double, tax savings. And then later on, when I take the money out, if I use it for qualified expenses, then I don't pay any taxes on it then. And so I get another tax savings then because I don't have to pay any money on the taxes then. So when you talk about triple, I mean, that's almost a quadruple. Federal and state tax deductible, federal and state tax free when it comes out, done correctly. So that's just, I don't let the Uncle Governor or Uncle Sam have any of the money from the earnings on those accounts. And that makes it much more efficient. Now, when we take money out of an HSA, a health savings account, the only way for it to be tax free on the distribution is to have it be used for qualified medical expenses. But those qualified medical expenses only have to have happened while I had the account. They don't have to have happened in that year that I took the money out. I can be reimbursing myself for something that I paid for a couple of years back out of my own pocket. So I start the HSA in 2020. And I put my 5,000, whatever the number is, in. And I do this every year. And I'm pretty healthy. I don't go see the doctor. I'm not crazy. I haven't broken any bones lately. And I go along and haven't spent much out of the HSA. So the majority of that 5,000 has been accumulating for maybe the next 10 years. And maybe now I'm getting old enough to retire, and I've built up 10 years later. I've put in $50,000. Maybe there's 49,000 of it left after spending money. But over the years, I've gone to the doctor here and there, and I've built up a couple things here and there. If I have health expenses in that year, I can always take it out tax-free. But I keep track. I keep a ledger. I keep track of everything that I spent on qualified health expenses for the past 10 years that I paid for out of my pocket. And I can reimburse myself for those expenses at any time. So when I retire 10 years later, maybe I want to buy something that, an RV or, whatever the case may be, with $40,000. And over the 10 years, I've had $40,000 of qualified medical expenses that I paid for out of my pocket. Rather than taking the money out of my HSA, I can now reimburse myself in lump sum for that $40,000 10 years later.
Wow.
As long as the expenses occurred while I was eligible for the HSA account, it doesn't matter when I reimburse myself for those expenses. I could do it in the future. I can do it later. I can do it whenever I want. It's kind of building my own tax rate. Now, the reality is I did pay medical expenses with after-tax money during that period of time. And so that's where I said it was somewhat misleading. But by using it this way, it's another form of additional savings that can be done on a tax-free potential basis going forward.
So we're talking about you get the deduction going in. So you get to deduct the money that you put in. That money in that account will grow what we'll call tax deferred because you haven't used it yet. But that money will grow tax deferred. And then on the way out, if you use it for qualified medical expenses, and whatever those expenses occur, as long as you use that to pay for them, even if it's years later is what you're saying,
yes,
that money, all that growth comes out tax-free.
Right, as long as the actual expense occurred when I was contributing to the HSA. Now, I can't go back and reimburse myself for an expense that I had in 1975 before HSA even existed. That you can't do that. But if I have an expense that instead of taking the money out of the HSA, I just paid for out of my pocket, that's a qualified expense. I can reimburse myself for that. There's no deadline on when I have to reimburse myself.
Yeah.
I guess we should be quiet though, because if the IRS hears us, they may put a deadline on it. But so far they haven't, and we can do it years in the future.
Yeah, and so in other cases, as we were talking about with Roth or traditional, you can get a deduction up front. It can grow tax deferred, so I suppose that's a double kind of tax favored status.
That's a traditional.
Traditional, yes. I'm sorry, traditional. It can grow tax deferred, and then when it comes out, though, you're going to be paying taxes on whatever the growth is. And you mentioned the Roth earlier. I don't get a tax deduction now, but I put the money in the Roth. It'll grow tax deferred, and then if I follow all the rules and do everything properly, I can take out the earnings at a designated time tax-free. So there are a couple of things there, but this is the only thing, and I just repeat this as I've said, that you have told me.
Tax deductible going in?
Tax-free coming out, as long as you follow all of the rules. And, of course, that's a very important thing. This is a health savings.
Yeah, following the rules for most people is very important.
Now, okay, so, Professor, you said high deductible a little bit ago. Is this a requirement of the health savings account? Right.
One of the requirements of the health to be eligible to contribute to a health savings account, you have to have a corresponding health insurance that allows you to qualify, and that is going to be a high deductible plan. And there are guidelines and limits on that. So it's not one where I get my health insurance and I basically don't have any out-of-pocket expenses. You're going to have potential out-of-pocket expenses. And you're going to be on the hook for the first X amount of dollars before the insurance company pays anything. So there's generally no $10 copays and things of that nature until you get past the deductible. But that's why I had one of these plans years ago where, let's say my premium was $1,000 a month for the family. And when I switched for a traditional plan with a $25 copay, whatever, and I switched over to the health savings account, my premium dropped to like $500 a month instead of $1,000 a month, but it allowed me to put $500 a month into the HSA account. So out of pocket, I was about the same. It was $1,000 a month in premium for the original one. It was $1,000 combined contribution to the premium and or the contribution to the HSA for the HSA health savings account plan. The difference was at the end of the year, if we didn't spend $6,000 in expenses for the doctor, I got to keep whatever was left over. Whereas if I had my traditional insurance, they weren't giving me a rebate for anything I didn't use.
Unfortunately.
And so now it doesn't work quite as clean as that anymore, where the premiums are not quite as competitive, I should say. But there still can make a lot of sense for somebody who it does not have chronic, ongoing, everyday expenses for healthcare. Somebody who doesn't go see the doctor all the time, who basically, unless it's a big time emergency, that they don't see the doctor at all. And there's a lot of people like that. And there's a lot of people that would like to say, well, if I'm going to spend $1,000 a month for insurance, I'd like to be able to keep some of that in case I don't need the insurance. If I need the insurance, hey, I've got the money to pay for it. It's done. Insurance covers the rest. It is what it is. Unfortunately, that stuff happens. But if I don't need it, I don't have that catastrophic issue, and I get to keep some of the money for something other. Now, if I don't have qualified health expenses ever, and I want to take money out of the HSA, then I will pay taxes on the earnings on it at some point in the future. So you do have, but
is there a penalty ever on that?
At some point in their life are going to have some qualified medical expenses.
Yeah.
It's just life in general, right?
Is there ever a penalty on that for taking it out, for
if you take it out prior to age
taxes.
65 and there's not a corresponding medical expense, that's a penalized event. And it's a big penalty. It's more than an IRA. It's 20%.
20%. But you have to be age 65. So you have to be age 65 or older then.
Now, once you're 65 or older, if you take money out just for any reason you want, the earnings are taxable but not penalized. Now, this is different than the IRA, which is a 59 and a half age. This is a 65 age. But the penalty goes away at 65. It's still taxable if it's a non-healthcare reimbursement or a non-healthcare related qualified expense.
Yeah. Now, this sounds like a great deal, and it is, I suppose, for the right person. Who should not consider something like a health savings account, in your opinion? Somebody
who has chronic illnesses, who are using their insurance all the time. Somebody, who is, has a family that for whatever reason, one of the families I grew up with, they had 4 or 5, kids in the family, and at least one of them was in a cast pretty much at all times during the year. They were at the doctors all the time. So they know, and if they knew that they would blow through that health savings account every year, so they weren't getting anywhere ahead. Somebody who's chronic, somebody who has a family history that's going to be an issue where they're going to have ongoing medical expenses every year, and they're not going to get a chance to actually have some money left over at the end of the year from the money they put in.
And this is more because of the high deductible nature of it. Is that what you're saying?
Well, it's because you're not getting anywhere. If you spend every dime in the health savings account every year because you're using it every year, big deal. You're not saving anything. You're not getting anywhere. The people that should consider a health savings account are the people that don't use a doctor all the time and don't expect to, and can end up keeping some of the money they spend on the overall premiums coming out of their pockets and build up some extra savings.
Okay, so there would be no real benefit for doing it unless you don't use your health insurance account all that much.
Right, because if you're using your health insurance all the time, most likely you can get a better premium with a $25 copay if you're going to spend all the money in the HSA anyway. The combination between the premium with the traditional policy and the premium and the health savings account combination, you're probably going to be more out of pocket with the health savings account if you use your doctor a lot.
Health savings accounts. I don't know that a lot of people know about them. You've talked to...
They've been around for quite a while now.
A long time. The high deductible plans, as you had said, I guess were a little more attractive a while back than they are now, or not?
Yeah, they were. The premiums were the premium for the high deductible plan was quite a bit lower than the traditional plans. Now they're inching up, and the combination of the premium and the contribution to the HSA to cover that deductible, in many cases, is now more than what you could get a traditional plan for. But if you get to keep most of it, then it's still you're still better off.
Now, one last question on this. In order to get the tax-free, it's got to be spent, and it's not on qualified medical expenses, but the age 65 is where the penalty stops. That's where a lot of people go on Medicare anyway. So, Professor...
Exactly.
Yeah, so...
It is coordinated with that.
Yeah, so...
And if you are on Medicare, you cannot have...
There you go.
Now, you can have the account if you've been contributing to an HSA over the years, and then you turn 65 and go on Medicare. It's not that you have to dissolve the HSA account. It's just that you can no longer contribute to it. You can still use it to take distributions to pay for qualified medical expenses that are not covered by a medical insurance, Medicare and otherwise. You just can't contribute to it anymore.
So the contributions have to stop at that point.
In the month that you start becoming, or the month you start taking Medicare. What
if you accidentally do contribute to it?
Then there's a penalty.
Just so you know, there is a penalty.
Yeah.
Okay. These are, again, called health savings accounts. Professor, they are right for, like just about everything else, they are right for some people. They are not right for others. But if you want to know more about this stuff and you want to know whether or not a health savings account may be a good savings vehicle for you, it's probably a good idea to talk to your financial advisor about that. You may have to get into some of your medical... Do you have to get into any of your medical history, I guess, maybe?
Well, to get the health insurance, sometimes you have to get into medical history.
Yeah, but anyway.
It's all a matter of the health insurance. Once you have the health insurance that is HSA eligible, the HSA is just a formality to open it and start contributing to it.
Yeah, it's not all that difficult. So if you want,
unlike an IRA, you do not have to have a job to contribute to this.
Yeah, it's kind of nice, isn't it?
Right. And so it's available to anybody, whether they work or they don't work. Maybe you retired early and you've got insurance. You retired at 60 and you're not eligible for Medicare for 5 years. And you use this type of insurance to cover you until you're at Medicare age. You don't have to have a job. Now, sometimes it helps because some employers will actually help you make the contribution to the HSA account.
Yeah, check with your employer on that one. But
yeah, because that could come in
could
really
be helpful.
Nice.
Professor Rick Plum, I thank you. Chief Financial Planning Officer for Lucia Capital Group. If you want to get in touch with Rick Plum, you can do so through our website, luciacap.com, LUCIA-CAP.com, or give him a call, or any of the Lucia Capital Group advisors that are sort of underneath Rick's guidance, tutelage, whatever you want to say it, 800-644-1150. That's the off-air number, 800-644-1150. You can also send us an email there at the luciacap.com website. Ask us questions there. We don't always get to emails here on this program, but sometimes your questions will spur a nice topic, kind of like the one we were just talking about here. LuciaCap.com, or again, 800-644-1150. Not bad for the first episode of 2021, Professor Plum. You know?
Well, here's praying 2021 is a better year than 2020.
Well, as we said earlier, I don't know how it can be worse, but hey, let's not think about that. All right, we are out of time. Once again, 800-644-1150, the off-air number. I'm Johnny Dean for Professor Rick Plum. Thanks so much for listening to us. We'll talk to you again next time.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material concerns tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. We cannot assure the accuracy or completeness of these materials. The information in these materials may change at any time and without notice. The information contained herein does not constitute an offer to sell or a solicitation of an offer to buy securities. Investment products described herein may not be offered for sale in any state or jurisdiction in which such an offer, solicitation, or sale would be unlawful or prohibited by the specific offering documentation. No client or prospective client should assume that the presentation or any component thereof serves as the receipt of or a substitute for personalized advice from LCG or from any other investment professional. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.